sources, business, finance, sources of business, finance. What is the meaning? What comes to your mind if someone to ask you, what is the meaning of sources of business, finance? Or if if they say sources of business, finance, what is the meaning? What is the meaning? What is the meaning? Habakkuk, sources of business, finance. Sources of business, finance. If they say sources of business, finance, what comes to mind? Habakkuk, can you hear me? Habakkuk, can you hear me?
Hello there.
Yeah.
It's areas business. It's area businesses used to raise funds for their organization.
Okay. All right. That is very nice. That is very nice. Abena, sources of business finance. This is sources of business finance. What is the meaning?
Ways in which business gets its money. Sources, how they get their finance.
Okay. All right. That is nice. Kobe, sources of business finance. What comes to mind, Kobe?
With sources of business finance, we are looking at how businesses raise capital to finance their activities.
Okay, that is very nice.
Thank you.
All right, you're welcome. If they say sources of business finance, basically we are talking about where businesses get their capital from, especially money to finance their day-to-day operations. Where do they get money? As a business person right now, if you want to start business, where are you going to get the money? Or where do you get the money from before you are using it to run your business? That is the sources that we talk about. So the sources can be of many forms. You can go to the bank and take loan. You can go to your friend and take loan. You can even do personal savings and those things. Those are what we are saying, sources of business finance. So where businesses or entities, organizations get their funds from to finance their business operations is what we call the sources of business finance. What are some of the things do you think as a business person you are going to consider before deciding where to go and get your money? What are some of the things that you decide before you have to look at before you say, okay, let me go and borrow the money from my friend, or let me do personal savings, or let me go to the bank and borrow? What are some of the factors that you are going to consider? What are some of the factors you are going to consider before you decide on which source you are going to use? What are some of the factors that you are going to consider for you to decide, oh, I have to go to the bank to go and take the money, I have to borrow from my friend? What are some of the things that is going to necessitate your decision as to whether to go to the bank or as to go to a friend, as to do personal saving yourself? What are some of those factors that you are going to consider? All right. How about you?
Okay, so I think you look at what you want to do as a business.
Okay.
The size of business. If it's something petty, I think you can use your personal savings or seek for funds borrow from friends or family members. But if you want to do something huge like importing cars, manufacturing cars, then I think you need a very large capital. So it means you should be able to talk to banks. They will be able to give you such huge amount of money. Yeah.
All right. That is very nice. So the nature of the activity that you want to undertake, or the size of you see, you have put 2 points into 1 point. You see, the size of the activity that you want, or the nature of the activity that you want to undertake, or the size of the company. That is a very nice submission there. All right, Abena, what are some of the things that you consider before you decide whether to come to me and borrow money, or you go to the bank, or you provide the money yourself? What are some of the factors that you are going to consider before you decide on?
How flexible the person you are going to borrow from.
Okay. Flexibility in terms of?
How flexible yes. In terms of payment time, the duration, the interest rates, you have to take all of those things into consideration before.
Okay. All right. That is very nice. Flexibility has to do with the payment terms. You see, if you go to the bank, they are going to give you a proper payment terms, like every month pay this amount. But if you should go to individuals, every day they will be at your neck, knocking on your door that they want to take their money. So sometimes you also have to talk about the flexibility. Flexibility has to do with how the terms of the, if after taking the money, how are you going to pay it? What is the payment schedule? What is the payment schedule? That is the flexibility that we are talking about. And you also mentioned interest. Interest has to do with the cost of financing. That if you should do personal saving, you see that it's very cheaper than if you should go to the bank. A bank, you are going to fill a form for processing fee and some things. Are you getting it? Yeah, so the cost also matters. The flexibility also matters, and the nature of the activity also matters, or the size of the company also matters. What else? What are some of the factors that you consider before you decide on which source of business finance you will use or choose? All right. What else? What else? What else? All right. So I hope if they ask you this thing in exam, you can write something, isn't it?
Yes, sir.
All right. It is even in the slide. So let's move on to the various sources of business finance that we have. You see, basically there are only two sources, which are the short term and then the words, the long term. So we look at the short term first, and we look at the words, the long term. We look at the short term first and the long term. If they say short term sources of business finance, what comes to mind? Short term source of business finance, what comes to mind? Habakkuk, short term source of business finance.
So, short term, the duration in which you are supposed to pay back the money isn't long.
Okay.
And I think they are not huge. They are used to finance little things in the business.
Okay. All right. That is very nice. Abena, short term source of business finance. Short term source of business finance. What comes to mind?
Okay, I think it's the money you need for the daily operation or some short-term operation of the business.
Okay. That is nice. Brian. Joycelyn.
Yeah.
Yeah.
Good morning.
Yes. How are you?
I'm fine, thank you, sir. When you talk about the short-term finance, we are looking at acquiring financial support within a short period for a particular event, which is not going to expand more than an average year of, let's say, 5 or 10.
Okay.
So you are looking at just acquiring some finances for a support for a short-term exercise.
Okay. All right. That is nice. That is very nice. Is that Austin? Brian, is that the Austin or another Brian? All right, let's come to short. If they say short term, we are just looking at, you see, those sources.
Brian.
You are Brian, eh? All right. Then Austin is not yet here. All right. If they say short term, we are just talking about where we get money to finance our maybe mostly working capital items. You see, where we are going to raise money that we are going to pay within a year. It will not expand more than 3 years. The duration for us to pay the money back will not be more than 3 years. And these are always done to finance working capital items. We go for these sources to finance working capital items. And example of these sources, Example of them are what? Example of the short term are what? Example. Example of them.
Say bank overdraft.
Okay, bank overdrafts. Okay, bank overdrafts. Bank overdrafts. What else? Bank overdraft. What else? Bank overdraft. What else? What else? What else?
Traded credit.
Is it
Trade credit.
trade credits? Okay. Well, if they say let's take them one by one. Bank overdrafts. If they say bank overdrafts, what is the meaning? What is the meaning? And who enjoys the bank overdrafts?
More than bank overdraft is, I think, what you have in your account.
Just come again.
Bank overdraft is like being given the permission to withdraw more than what you have in your account balance.
Okay, that is very nice. But which account holders enjoy the bank overdrafts?
Current
I think
account.
it's a current, yeah.
A current account holder. So that is one of the benefits of you having a current account. Because they know why should they give that into current account holders, not deposits, not savings account holders or deposits account holders? What do you think is only current account holders that can enjoy?
Because they are using it for business.
All right. The assumption is that you see those people, money comes in every day.
They have regular income.
Yes, money comes in every day into the account, so they can pay within any time. So for the bank overdraft, what happened is that you see there is no payment terms for your how you are going. There's no schedule for the payments. You pay as soon as the money comes in. The bank will take the overdraft. As soon as the money comes in, automatically then they will deduct the overdraft. So there is no payment schedule for the overdraft. So the overdraft is allowing you to withdraw more than what you have in your account. That is an overdraft. Trade credits. Let's move on to trade credits. Trade credits. Trade credits. What do you mean by trade credits? Habakkuk, trade credits.
It's basically buying the goods in which you deal in, you use as your business on credits.
Okay. All right. So that means buying the goods on credit and paying later. That is the trade credit. Some people, they can also call it trade payables. You know that whenever you buy on credit, you are going to have creditors. So sometimes they name it to be trade payables. You are not wrong. You are not wrong. So trade credit has to do with buying that you on credits now and pay on a later date. That is a trade credit. That is a trade credit. What else? What else? What else? What else? All right. Another one is a short-term loan. We have short-term loan. You see, we have loans that if you go to the bank, they will give you for 3 months, 4 months, and 5 months, and those things. That is what we call the short-term loans. Short-term loans. But these loans, the difference between the reason why people normally go for the short-term loans than the bank overdraft is that for the short-term loan, the bank is going to give you a payment schedule. How you are going to pay the money. They are going to give you a payment schedule. They are going to give you payment schedule. So you know at the end of this month or week how much you are paying. But for overdrafts, there is no schedule. As soon as the money hits your account, they will deduct it. So that one, even if you plan to use the money for something, the overdrafts can be like the quick loan, MTN quick loan. You see, as soon as the money hits your account, they will take it. Even if you have plan for that particular money, you have no choice. That is one thing. That is the one bad thing about the overdrafts. You can't plan properly for your business operations because as soon as the money hits your account, they will deduct it. Right now, you you'll be expecting someone to send you money so that you use the money to check how far. And instead of the person to inform you before sending the money so that you can change the phone number, the person will you just be there, the person will call you that, oh, I've sent it to, before you know, MTN has deducted the money. That is one disadvantage of the overdraft. Is you don't have any schedule, you don't have any plan to how you are going to pay the money or something. So people normally go for the short-term loans than the overdraft because of this. All right. Another one is what we call operating lease. I hope all of you have heard about leases before. Lease.
Yes, sir.
Yeah. So what is the meaning of lease? If they say leasing, what is the meaning? Lease.
So it's whereby the business rents an assets and pay rents to the owner of the assets for a short period of time.
Okay. So this one, one person having an asset which is idle, which is lying idle, and you see, well, I need this asset, so let me come and use it for 3 months or 4 months, and I'll pay rent. That is what we call operating lease. Operating lease are for short period. We also have other form of lease that we call finance lease, which normally takes maybe like most of the part of the useful life of the assets. It can be 10 years, 4 years. They are for long term. So operating lease has to do with you going to hire an asset from someone and use it for a short period of time. That is also an operating lease. Or the company can also decide to lease the asset to someone for a short period of time. The company will get the money. It's both ways. The company can do it, or someone will lease the asset to the company. Are we okay there? We also have something that we call factoring. Factoring. I hope some of you had heard about factoring before. Factoring. Have you heard about factoring before? Factoring.
Yes, sir.
Factoring. What is the meaning of factoring?
So it's whereby a business gives the debts people are owing the business to another company at a discount so that they will collect the money on their behalf.
Okay. I hope you have heard about debt collection companies in Ghana. I don't know. I know there are some, but I don't know their names. So what those people, they are specialists in collecting. They are specialists in helping you to collect or recover your debt, especially the receivables. So if a company needs money and they have rich receivables there, they will just go to these debt collection companies and they'll say, oh, I have this number of people owing me. So what will happen is that if it is 10 million, okay, give me 9 million. Go and give me 9 million and go and collect the money. So it's just like you are using your receivables to, this one is not borrowing. You are using the receivables to, or you are selling your receivables to that particular company. But what happens mostly is that you will not get the actual amount that the people are owing you, because it is likely that some people, they will not pay. So if it is 10 million, you can go and sell it for 9 million. And those people, they have strategies, they have means of collecting or recovering the money back. And this factoring can be of two forms. There is one that as soon as you have sold the receivables to the factoring company, whatever happens afterwards is none of your business. So you just sell it to them, and that is the end. Whatever happens between the people that are owing you and the debt collection company is none of your business. So that one, we call it factoring without recourse. We have factoring without recourse. The factoring without recourse is where the company is going to sell the receivables to the factor or the debt collection company, and that is the end. Whatever happens between them, you don't care. It's none of your business. So we are giving you this for 9 million. Go and take the money. Whatever happens, we don't care. That is a factoring without recourse. But we have another one where they are going to give you the money and say that if within 6 months we didn't collect our money, you are going to pay the money given to you back with interest. That is what we call factory with recourse. Factory with recourse. And if you in financial reporting, we are going to look at financial instrument that we are going to look at these factoring issues, how to account for them. So one is whenever you sold this thing to them, you don't have any business to do with them. But one is they'll give you the money to you as a loan and say, okay, if we are able to collect the money within 6 months, we pay the balance. But if you're not able to collect the money within 6 months, then you pay the money given to you with interest. That is factoring with recourse. So factoring has to do with you selling your receivables to another company for you are selling the receivables to another company to get money to run your business operations, or you are telling another person to go and collect the money. That is a factoring. You are selling your receivable. You are selling your debtors to the company that they should go and chase those people for their money. That is factoring. That is factoring. That is basically what we call factoring. All right, let's count another one that we call invoice discounting. Invoice discounting. Invoice discounting. What do you mean by invoice discounting? Invoice discounting. Have you heard about invoice discounting before? These are all short-term sources of business finance. So if you are writing, write them. If you're writing, write them. Invoice discounting. Have you heard about invoice discounting before? Habakkuk, have you heard about invoice discounting before?
So I've heard.
What is the meaning?
So the understanding is unclear.
The understanding is not clear.
Yeah.
Okay. All right. If they say invoice discounting, it's similar to factoring, but invoice discounting, what we do is that we use the receivables as collateral security to take the loan. So you need money, you just go to the bank and say, well, I need this money, or savings company and say, I need this money, but I have this number of people. So give me the money. If I'm able to, or if I collect the money from people, then I'll pay you back. That is invoice discounting. That is invoice discounting. So you are using the receivables as a collateral security. And for the invoice discounting, the company will collect the debts each by itself. The company will go after the people and collect the money. But for factoring, the company has sold the receivables to the factoring company. It is a factoring company that is going to collect the money. But with invoice discounting, the company that you're going to take the loan from has nothing to do with how the money is being collected or not. They have just given you the money. So it is the company that is going to go after the debtors and collect the money and come and pay the company. But for factoring, it is the factor or the factoring company that will go after the what? The debtors. The company has nothing to do with the administration, how the money will be collected or not. The company has nothing to do with that. It is the factoring company that will do that, that will go after the people. But for invoice discounting, the company is using the receivables as a collateral securities to secure loan. So the collection and administration of the debts is still the responsibility of the company, not the company, not the institution that the company is taking the loan from. That is the difference between them. In exam, they can ask you the difference. Differentiate between factoring and invoice discounting. It has come before. It has come before. It has come before. For the factoring, the company is selling the receivables to the factor or the factoring company, and the administration and the collection of the factory the debts is the duty of the factory company. But for invoice discounting, the company is using the receivables or the debtors as a collateral security to secure loan. The administration and the collection of the debts is the responsibility of the company itself. Are we okay there?
Yes, sir.
Okay. Are we okay with the difference?
Yes, sir.
All right. Let's move on. Let's look at the long term. That is basically about the short term. Let's look at the long term. The long term. If you say long term sources of business finance, what do you mean? Long term. And what are some of the examples? Long term. Long-term source of business finance. Long-term source of business finance. What do you mean? Long-term source of business finance. What is the meaning? Long-term. What is the meaning? Long-term. Long-term. What do you mean by long-term source of business finance? All right, let me start sharing my screen so that we move on fast first. Okay. So long-term, if they say long-term has to do with where we get money to finance capital decisions or capital investments. You can't go and take a loan, which is long-term loan, to come and buy goods to sell. You see, we do that to acquire long-term assets or investments. So long-term source of business finance are basically for capital decisions or to acquire maybe plants, to acquire equipment, to acquire machinery. So we go for this money to acquire or to finance capital decisions. Capital decision has to do with acquisition of non-current assets. So the long-term source of business finance is basically for acquisition of what? Capital assets. And examples of these are what? The first one is the equity finance, the issue of shares. So if you want to start business right now, which will be for 5 or 10 years, you can just go to the Ghana Stock Exchange market and issue shares. So issue of shares is about you giving your shares out for people to buy. And basically we have the ordinary people that will buy. If you want people to become part of the company, then you issue what we call ordinary shares. But if you don't want people to be part of the owners, you want them to be seen as creditors, then you issue what we call preference shares, or you also issue what we call debentures. So the first one is the equity finance. If you say equity finance, we are talking about issue of equity shares. If you say equity shares, we are talking about the ordinary shares to investors through new issue. So you can have shareholders, but you still want more money. So if you want more money, what you are going to do is that you can decide to issue shares to the existing owners, or you can also try to change your reserve to equity, which what we call bonus issue. Bonus issue means you are changing your retained earnings to what? To shares. So what you are going to do is that you are writing off your retained earnings to equity shares. So we call it bonus issue. Changing your reserves to shares is what we call bonus issue. You can also decide to issue shares to the existing shareholders. You can also decide to issue the shares to existing shareholders, which what we call right issue. We can also have another way that we call script dividend. Instead of you to pay cash dividend to the shareholders, you issue shares to them. So you are using shares to pay for dividends. Instead of you to pay cash 10,000 to them, you issue shares that to the value of the 10,000, what we call script dividends. So under this one, we have bonus issue where you are going to change your reserve to equity shares. You also have right issue where you issue new shares to existing shareholders at a discount. This one is always done at a discount to encourage them to buy. It's always done at a discount. So if the share price is 10 cedis, you can issue to them at 8 cedis. You are issuing at a 2 cedis discount. You are saying you are doing this to encourage them to buy. So the first long-term source of business finance is equity finance. That is equity finance. All right. The next one is what? All right. let's look at the stock exchange market. Let's look at the stock exchange market before. Okay, don't worry. Let's look at the source of finance before we come to the stock exchange markets. All right. So the first one is equity finance. The second one is what we call debt finance. Debt finance can be issue of preference shares, issue of debentures, issue of loan notes. Those are all debt finance. Those are all debt finance. Okay, between debt and equity finance, if you are finance manager of your company, which of these are you going to recommend to your company? If you are finance manager of your company, which of these long-term source of business finance are you going to recommend to your company? Which of these sources? Is it equity or debt? Which of them are you going to recommend for your company, and why? Why? Why will you say your company should choose equity finance over debt finance, or choose debt finance over equity finance? How about Cook?
Hello, sir.
Yes.
Senior, it depends on the motive.
Okay.
One organization, the finance manager may decide that maybe the taxes they are paying is too much.
Okay.
So they will go for the loan.
Okay.
Long-term loan. So
Okay.
the interest they will pay will reduce their net profits, so that they will be able to reduce the taxes they are paying.
Okay.
And then also, one will also say that because of the interest they will pay on loans, because of that, they will go for the equity, because the equity, there is no interest to be paid, and even you decide when to pay dividends to the shareholders.
Okay.
So yeah, it depends on what you want to achieve.
Okay.
I think.
All right. That is very nice. That is very nice. That is very nice. That is very nice. All right. Anything else? Austin. Austin, which of these are you going to recommend, and why? Austin, which of these are you? Yeah.
Yeah, I recommend equity finance.
Why? Why would you recommend the equity finance?
Okay, let's say for what I know, equity finance, though, I think the equity finance will be from the ordinary shareholders. So it's kind of from existing shareholders. So in case of any debtors, or in case of the company's inability to pay, I think there will be no issue as compared to debt capital or preferential capital, where they are supposed to be paid or receive dividend. Yeah. So yeah, that's what I can say.
Okay, that is nice. That is nice. That is nice. You see, some people, they can also, you see, all that you have said, is the motive. It depends on the motive. But in the exam, they can ask you, why will you recommend debt finance over equity finance to your company? What they are trying to ask you is that, what are the advantages of debt finance over equity? Are we okay there? So what they are trying to ask you is that, give us the advantages of equity finance. The first one is what Habakkuk said, that the interest that you are going to pay is tax deductible. It's tax deductible. It's tax It's tax deductible. It's tax deductible. And also another one is that, is it for for debt finance, there is a schedule to how you are going to pay it. Are you getting it? That means every year, there's a fixed interest that you are going to pay. So if you are making profit, you will pay. So you can plan towards the interest payment. You know when to pay it and when not to pay it. But for equity finance, you see, some of the shareholders, they can, because of their investment, the risks involved, that after the business go bankruptcy, they will not be able to recoup their capital. They will be giving you pressure to declare dividends every day. They'll be giving you pressure to declare dividends every day, or there'll be a pressure on the management. But for debt, nobody's coming to give you pressure. The money will just be there. If you make profit, then you pay our interest. If you make profit, you pay our interest. If you don't make profit, then you defer the interest to next year and pay. Are you getting it? Another one also is that, you see, that debt finance does not give ownership. Does not give ownership. You see, you people, you are 5 and you own a company. Now you want to bring another people. You don't know the person. You are bringing a new person to the company. You don't know the person. There will be a dilution in the ownership. And what shows that the second person or the 6th person coming has the same idea as you people. Are you getting the idea? So sometimes even debt finance is cheaper. It's cheaper than equity finance because of the risk involved. So the equity finance, you see that shareholders are expecting higher returns. The cost of equity finance is always high. It's always high. And debt finance, you can just go to bank and negotiate with them and take money. But for equity finance, if you're not listed on Ghana Stock Exchange markets, you have to go and follow the listing requirements, do everything, and get your company listed before you can issue equity shares. Before you can issue the equity shares to the public, unless you want to do placing, where you are going to identify prominent people, some prominent individuals, and issue the shares to them. But for equity shares you want to issue to the public, then you have to get listed. You have to get listed. We look at those ones, the stock exchange market. So basically the two sources of business finance that we have, which are long-term, are equity finance and debt finance. We also have what we call finance lease. Finance lease, we have spoken about operating lease already. Finance lease for a long term. So the company can lease its either asset to another company for 10 years, or the company can go to another company and take non-current assets for 10 years or 5 years, something more than 3 years. That is what we call the equity. That's what we call the finance lease. Finance lease. Let's look at, if you are a company, that you want to issue shares to the public for the first time, what are you going to do? The first question is, are you listed on the Ghana Stock Exchange markets? What is stock exchange markets? What is stock exchange market? What is the?
So it's a market where securities are sold.
Where securities are sold, and one of these securities,
sold.
one of these securities is the equity shares, isn't it?
Yeah.
So if you are a company that you are not listed on a Ghana Stock Exchange market, you cannot trade your securities in public. You cannot trade your securities in public. So if you are a company that you want to get listed and you want to issue your shares to the public, what are the things that you have to do, which we call the listing requirements? The listing requirement. Debts are traded on a stock exchange market. Equity shares are also, or equity are also traded over there. So we are going to look at the stock listing requirement for equity shares and also debt instruments. So you can see that there was a time that MTN opened some forum for you people to acquire shares through their mobile money line, isn't it? Some of you, do you have shares with them? Some of you have shares with them. So, like, did some of you receive message from MTN that you can buy their shares using Momo or something?
Okay.
That was around 2015 or something. You see, do you know why MTN was doing that? It's not that they needed money.
No, yes.
Do you know why they are doing that?
No.
Why?
You don't know?
Okay.
Oh, like, okay, maybe you can take your phone and search companies on the Ghana Stock Exchange market. You see MTN as part of them. You see, they want to get listed on the Ghana Stock Exchange market, and the requirement is that one of the requirements is that for you to get listed, 25% of your equity shares must be owned by the public. Must be owned by public. Not that MTN, they don't have money. They have private owners, private equity finance owners. They have the people over there, but 25% of their shares are not owned by the public. So for you to get listed on the stock exchange market, 25% of your ownership must be for the public. MTN is not having that. So they have to come and issue the shares to the public so that they can get a 25% ownership by the public. That's why they were issuing the shares to the public. Are you okay there? It's not that they needed money, but they want to meet the listing requirements. They want to meet the listing requirements. They want to meet the listing requirements. So one of the listing requirements of the equity shares is that the minimum capital requirement of the company must be 1 million shares. The company must have a 1 million shares that worth 1 million Ghana cedis. So the first listing requirement, take this thing very serious. There are 4. You can go to the exam, they'll ask you the listing requirement for shares. It can also ask you about debts. So the first thing is the minimum stated capital. It must have a stated capital after the public flotation of at least 1 million in the case of application relating to the first official list and 0.25 million for Ghana alternative market. You see, some of the companies that are not listed on the Ghana Stock Exchange market, they have a place, or they have a market, or they have a place that they are listed that we call Ghana Alternative Market, which is the GAST, right? So if you are issuing shares for the first time, if you want to get listed on the Ghana Stock Exchange market for the first time, they are expecting you that your stated capital must worth 1 million Ghana cedis. 1 million Ghana cedis. 1 million Ghana cedis. So some companies, they want to get listed, they have owners over there, but their shares are not up to 1 million Ghana cedis. So they will issue more shares to have the 1 million Ghana cedis before they can get listed. That is the first requirement. The minimum stated capital must be 1 million for what? Companies that want to get listed on the Ghana Stock Exchange market, and those that want to get listed on the Ghana Alternative Market. The second one is a minimum public float. Shares issued to the public must not be less than 25% of the number of shares of the company. I've said this already, isn't it?
Yes, sir.
Yeah, so the minimum public float must be 25% of your shareholding must be owned by the public. Payment of shares. Shares must be fully paid for. So if you're issuing the shares, before you get listed, all the shares that you issue to the public or issue to the people must be fully paid for. No credits. Must be fully paid for. So payment of share must be fully paid for, except in very exceptional circumstances. The exchange will refuse listing in respect of partly paid shares. So if the shares are issued and all of them are not subscribed or fully paid for, the Ghana Stock Exchange markets will refuse you a listing requirement. You will not get listed. You can't trade your securities on the stock exchange market if your shares are not fully paid for. If your stated capital is not worth 1 million, if 25% of your shares are not owned by the public, they will deny you. The last one is the spread of shares. The spread of shareholders existing at the close of an offer should be, in the Ghana Stock Exchange market opinion, adequate with at least 100 shareholders after the public offer for the main board and 20 for the Ghana Alternative market. Your shareholders must be up to 100. The minimum must be 100. You must have 100 shareholders. You must have at least 100 shareholders before you get listed on the stock exchange markets. Are we there? So basically, these are the listing requirements for shares. The minimum stated capital must be at least 1 million for those who want to get listed on the stock exchange market, and 0.5 million, 0.25 million for Ghana alternative markets. Your minimum public floats, 25% of your shares must be owned by the public. Your shares issues must be fully paid for. And your shares, after the issue, you have to have at least 100 shareholders. If you don't have any of these, you will be denied the listing requirements. Are you there? Let's come to debt. Listing requirement for debt securities. A company or institution seeking the admission of debt securities to the Ghana Stock Exchange market may be considered for such admission if the security concerned has a total issue amount of not less than 1 million face value of has not more than 1 million Ghana cedis face value, and there should be at least 50 holders of such securities. So the face value of the bond that you want to issue is no less than 1 million Ghana cedis, and the total holders of that particular bond should not be less than what? 50. There should be at least 50 holders. That is for debt securities. Okay, let's look at methods of obtaining a listing. After, or if you want to get listed on the Ghana Stock Exchange market, what are some of the things that you do to meet the requirements? What are some of the things that you do to meet the requirement? That is the methods of obtaining a listing. Methods of obtaining what? A listing. If you want to get listed, how do you raise your 1 million equity shares, stated capital? How do you meet the 25% benchmark? How do you have the 100 shareholders benchmark? How do you make sure that your shares are being fully paid for? That is the methods of obtaining a listing. The first one is what we call IPO, an initial public offer. So what you do is that you issue your shares to the public. You just make your shares open, like the way MTN did. That's what we call initial public offer. So you just issue the shares to the public, and you be expecting the public to come and subscribe to the shares and pay for them. So you just issue the shares to the public, inviting them that they should come and subscribe to your shares, or they should pay or they should buy your shares. That is what we call the IPO, an initial public offer. This initial public offer can be issued by tender. If you say issue by tender, means that what you are going to do is that you issue the shares, then you sell the shares to the highest bidder. If you say, some of you have done PSA, isn't it? Some of you have done PSA, isn't it? Austin, you have done PSA. Yeah, Habakkuk.
Yes, please.
Habakkuk.
Sir,
Yeah.
I have a little challenge here.
Okay.
What are the debt securities? Is it the preference shares?
Yeah, preference share can be seen as debt securities. Anything that will not give ownership, any form of finance that is of long term but doesn't give ownership. So the debentures can be parts. Preference shares can be parts.
Oh, okay. And then the shares we initially discussed was
Equity shares.
Ordinary shares.
Yes, ordinary shares.
Okay.
All right.
Okay.
Okay. Are you okay then?
Yes, sir. Yes.
Jocelyn, you have done PSC. Austin, you have done PSC. If they say tender to the highest bidder or sell to the highest bidder, what is the meaning?
Is it tender to the highest
bidder, or you sell to the highest bidder?
Okay, you sell it to the person who offers the highest price. Maybe if someone offers 10 cedis per share and someone also offers 20 cedis, it means you have to sell it or choose the one who offers 20 cedis. That means sell it to the highest bidder.
Okay, all right. So for the initial public offer, we can also have a situation like that where people will come and name their prices. So we sell to the people with the highest one bidding. Are you there? So, but the initial public offer has to do with you issuing the shares to the public, to the general public. You're not going to do anything like black markets. No, you just give the shares out to the public, and the public, you ask them to come and subscribe for the shares or to come and buy the shares. That was what MTN did. They used the initial public offer, which is the IPO. IPO. Are we there? Are we there?
Yes, sir.
All right. We have another one called placing. Placing is normally done for the private companies. I've said that already. As a private company, if you are not listed on Ghana Stock Exchange market, your shares cannot be traded. Your shares cannot be traded in the public. So you can't issue shares to the general public. What we do is that we call something placing. Placing, what you do is that you identify individual investors and just invite them that they should come and subscribe to your shares, or you should come and buy the shares. But you are not going to leave the shares in the public domain. You just identify individual investors and ask them to come and subscribe to your share. So if you want to establish business right now, and you want it to be a private limited liability company, you can just go to Kennedy Japan, despite, and those people that they should come and subscribe to the shares. You invite them that they should come and subscribe to the shares. Not that you issue the shares and ordinary citizens like us will come and subscribe. No. We call something placing. You identify private individuals or private investors, and you give them the shares and they'll pay for it, not for the public. And private company, this is what they do, because they can't issue the shares to the public. So they normally use what we call placing. They normally use what we call placing. Are we there? Are we there?
Yes, sir.
Do you have any question with the placing, or we can move on? Austin, can we move on with the placing? Abena, Jocelyn, can we move on with the placing?
Yes, please.
Yes, before I continue, I have to tell you that this particular part of this one will go for 10 marks or 5 marks. It's always 10 marks or 5 marks. And you can go to the exam, they ask you about the listing requirements for shares or methods of obtaining listing, which is the initial public offer. You have to explain it. Placing, you have to explain it. You also call something an introduction. If you say an introduction means, you see, the company that wants to get listed on the stock exchange market for equity shares, the company has already met the listing requirements. The company has already met the listing requirements. So there is nothing for them to go and issue shares to 25% of the people. No, they already have the 25% of the shares owned by the public. They already have the seated capital more than 1 million. Their shares are fully paid for, and they have the 100 shareholders that you're talking about. So what you do is that they will just bring the old shareholders and they will get them listed on the stock exchange market. That's what we call an introduction. An introduction. So you just introduce your existing shareholders to the stock exchange market. They will get the shares will get listed, and they'll put those people as the owners, because you have already met the listing requirements. You have already met the listing requirements. So you just write to the stock exchange markets that you have already met the listing requirements, so they should list your company, or they should put the shareholders on the stock exchange market. That is what we call an introduction. Do you have any question? Do you have any question? Can we move on? Habakkuk, can we move on? Jocelyn, can we move on?
Yes, please.
All right. Are we all okay?
Yeah, we can move on.
All right. We also have something that we call underwriting. Underwriting. Underwriting is also a way of you obtaining listing requirements. Okay. Underwriting, what we do is that, you see, there are some companies that will help you to get the shareholders. There are some companies that will help you to sell your shares. So what you are going to do is that you go into an agreement with the company that you want to sell 1,000 shares. So what the company will do is that the company will charge you, and the company will assure you that if we are not able to sell all the 1,000 shares, the remaining shares, we are going to buy it ourselves. That's what we call underwriting. So right now, I'm the underwriter and you are the company. Like, you have a company that you want to sell 1,000 equity shares. I will just come to you, or you come to me that, okay, you want me to sell these shares for you. But I will tell you that if I'm not able to sell the shares, all the shares, the remaining shares, I'll buy it myself. That's what we call underwriting. So what you do is that the person is going to charge you fees. They are going to charge you. You are going to incur cost, the underwriting cost, the issue cost. It can be any cost that the underwriter seems to be reasonable or appropriate for him to carry out the activity that you want him to do. So the underwriting has to do with you selling the shares or giving out the shares to an underwriter to sell them on your behalf. And an underwriter will assure you that if you are not able to sell any of the shares or any remaining shares will be subscribed to by ourselves, we are going to buy them ourselves. That is what we call underwriting. That is what we call underwriting. Do you have any problem with underwriting, or we can move on? So these are some of the costs associated with the underwriting. You have the underwriting cost, the stock market listing fee, fees of issuing house, investment banks, solicitors, auditors, and those things. Okay, these are some of the costs that you are going to incur if you want to use underwriting. Are we there? Or some of these are some of the costs that you incur when you want to issue shares. Costs that you incur when you want to issue shares. Sometimes you want to advertise in newspaper, national newspaper, you are going to pay. Sometimes you have to print the prospectus and distribute them to the people. Yeah, so those are some of the costs that you're going to incur. Some of the costs that you're going to incur. All right. Can we move on? Or are we okay with the underwriting? Abena, are you okay with the underwriting?
Yes, please.
Okay. So in exam, they should ask you that you should list or you should state some of costs that are associated with issue of shares on the stock exchange market. The first one is underwriting costs. If you're using underwriting, people are going to charge you. The second one is the stock market listing fee. They are going to charge you for the first time if you want to get listed. They are going to charge you for the first time. Fees of the issuing house. The auditors will come and audit the financial statements before you do this. You can also go and do consultation with people that will advise you on whether to go there or not. You are going to also incur that cost. Another cost is printing of the prospectus, because the people want to know how well you are doing before they invest your business. So you have to print the prospectus and share it to them. They want to know the prospect of the company. Is the company profitable? How are you doing over the years and those things? And sometimes they're advertising in national newspaper. You want to advertise in national newspaper, you are going to pay a fee for that. Okay. So if in the exam, the question asks you to state the listing requirement for shares. What are the listing requirements for shares? What are the listing requirements for shares? Austin, give me one. Listing requirement for shares.
First one is 25%. 25% of the shares, at least 25 of the shares must be issued or must be owned by the public.
Okay. Okay. That is very nice. Habakkuk, one.
Yes, all the shares issued must be paid in full.
Okay. Okay.
Yeah.
Jocelyn.
The minimum capital should be at least 1 million.
Okay.
And that of the other one should be 0.25 million.
Alternative Ghana, Ghana alternative market.
Yes.
Okay. Abena, are you the one who said it, or Jocelyn?
I said Joycelyn.
Okay. Abena, what is the last one? We have volume 4. What is the last one? Abena, are you there? Jocelyn, are you doing FR2 or MA?
Oh, I've passed the FR, so it's MA and FM.
Okay, that is a nice combination. So you were part of my last meeting.
Yes.
Okay. I learned that you are saying that I'm not correct. Is that true?
Hey, I've not even seen it though.
Okay. It's normal. Myself, I know that I'm not correct, so it's not a news.
I've not even seen that comment.
Abena is not there. So at least you should have 100
Then-
shareholders, isn't it?
Yeah.
Okay.
100 shareholders,
Okay.
and at least 50 debt capital.
Okay. So if you see those statements, minimum public floats, minimum stated capital, payment of shares and those things, if you can't write them, just write them the way you have said them. Are you okay then? If you can't remember them, it's not by force. Spread of shares, payment of shares and those things, just write them the way you say them right now. Are you okay? But if you can remember these ones, you can see it and explain them. No problem. If they ask you methods of obtaining listing, what are you going to say? Methods of obtaining listing. What is the first one?
IPO,
Which is?
initial public offer,
Okay. The next one is what?
listing,
And the third one is?
introduction,
Last one.
introduction,
Yeah, the last one we spoke about for underwriting.
underwriting.
So they can give you these four and they say you should explain it for maybe 5 marks or 10 marks. So if you are, that is, I'm just trying to explain it in a simple way so that you can get an understanding and write it yourself. Are you okay? All right. So last time, first I was saying that we have so many ways of issuing ordinary shares, isn't it? I said that you can do what we call bonus issue. Did I say bonus issue today?
Yes.
What did I say about bonus issue?
I think he said it is changing your reserves to shares.
Okay, changing your reserve to equity shares or converting your reserve to equity shares. Did I say something about bonus right issue?
Yes.
What did I say about right issue?
He said selling additional shares to existing shareholders
At a discount. That is very nice. Did I say something about script dividends?
No.
I say something about script dividend. Maybe you didn't hear. Habakkuk, did I say something about script dividends?
Straight dividend.
Yeah, script dividend. That is,
If I got you right, you mentioned that the organization they must pay dividends to their shareholders, especially the preference ones.
that is what I said. No, that is not what I said. Austin, were you there before I spoke about bonus issue, right issue, and the likes?
No, I wasn't there.
Okay, I spoke about script dividend. I said that instead of you using cash to pay dividend to the ordinary shareholders, you are giving them shares instead. Just did I say something like that today?
Then I wasn't there when you mentioned it.
Okay, the time I was talking about bonus issue, right issue, that was what I said. We have what we call script dividend. So instead of you paying cash as a dividend, you are paying the dividends in kind. You are issuing shares to them. You are giving them shares in return for cash. So you want to use the cash for different things, and you are giving them shares in returns for their dividends. So you give them, if the dividend is 10,000 Ghana cedis, that you have to pay a cash of 10,000 Ghana cedis. You give them shares that are worth 10,000 Ghana cedis. That is what we call script dividends. Are we there? We also call something split issue. You see, the split issue is not issue of additional shares, but if shares are issued at 1 cedi. Yeah, Habakkuk.
Yeah. Yeah, hello.
Yeah, Habakkuk.
I have a question with the bonus issue.
Okay.
You said it's converting your reserves into shares, right?
Yeah, return earnings,
So-
especially return earnings.
Yes. So when the business does that, who owns the shares? Who are the ones who holds the shares?
The reserves are for who?
The business.
No, who are the owners of the company?
The shareholders.
Which of the shareholders?
equity.
So if
The-
you are returning profits in a business, who are those returning the profits?
The ordinary shareholders.
So if they are changing the returns to the reserves to equity shares now, who will be the owners of the shares?
Ordinary shareholders.
Yes, so they are the owners of the shares.
So it means it will be apportioned to them.
Yes, it will be
the
apportioned to them.
percentage of their.
Yeah.
Okay.
Yeah, they will use
Okay.
appropriate rate for that. All right.
Okay. Okay.
Right.
Thank you.
All right, you're welcome. All right. I was saying something before. What was I saying? I was saying something about split issue, isn't it? All right. So you see, if shares are issued at 1 cedi, if you have shares 20,000 Ghana cedi which are issued at 1 cedi, it means that you have issued 20,000 shares, isn't it? All right. Sometimes we would like to, you see, because of the listing requirements, we can decide to increase the number of shares so that we can meet the requirements. So what they normally do is that instead of them issuing additional shares at 1 cedi to have the 40,000, or maybe we need additional 20,000 shares to meet the listing requirements. So what they will normally do is that, you see, instead of them issuing additional shares at 1 cedi, they will change the 1 cedi now to 50 pesos and say that they are issuing the shares to 50 pesos at 50 pesos Ghana cedi. So they divide the value into 2 or 3. So instead of them saying that all the shares are issued at 1 cedi, they will now say the shares are being issued at what? 50 pesos, so that they can increase the number of shares to 40,000 now, 40,000 shares. So they are not going to issue additional shares, but they will cut down the value per share, the share price. They can divide it by 2 and say they are issuing the shares at 50 pesos, which was originally 1 cedi. So you're not going to issue additional shares, but you change the value, the share price. You change it. That is what we call split issue. Split issue. You are issuing the shares at 1 cedi first. You are now saying it's now 50 pesos. You are issuing the shares at 10 cedis. You are now saying it's 2 cedis. You are doing that to increase the number of shares. So split issue, the main purpose is to increase the number of shares, Though you're not going to issue additional shares, but you are just changing the share price, the original share price. That is the split issue. Are we okay there? Can we move on? Can we move on?
Hello.
Yes.
There is it script or split? The one that you said
It's split issue, split.
No. You made a
Dividends.
previous explanation.
The
Yes,
dividend is
concerning-
script. It's script.
Okay.
Yeah, script dividends. SCRIP. Script dividends. But this one is split. SPLIT. Split issue. Are we okay? Just like you okay then.
Yes, please.
Okay, let's come to what we call bonus issue. Bonus issue. You see, what happened with the bonus issue is that the existing shares will be issued to the shareholders at a discount, isn't it? All right. So what happened is that, let's look at this. Let's look at this example. Let me use this example for you so that we see something. Then we close this thing on the source of business finance. Then we look at financial markets. Can you see my Excel sheet? Can you see my Excel sheet? Okay, let's look at this. You see, the company has 20,000 shares first, which are issued at, how much we issue it? At how much? How much we issue one share? Should we issue it at 5 cedis? Should we issue it at 5 cedis or? Okay, if we issue it at 5 cedis, what will be the total value of the shares? I'm sure that will be 100,000, isn't it? That will be 100,000. Are we there? Are we there?
Yes.
Okay. So you see, normally the bonus issue and then the right to issue are always issued in a proportion. So they can say 1 for 4. The company made a right issue of 1 for 4. 1 for 4. If they say 1 for 4, what is the meaning? 1 for 4. 1 for 4. Habakkuk, have you heard something like that before? 1 for 4. They have issued, there was a right issue of 1 for 4 shares. 1 for 4. 2 for 5. What is the meaning? 1 for 4. Habakkuk, 1 for 4. Have you heard that before? Austin, have you heard that before? 1 for 4.
1 for 4.
Yes, the bonus issue was made in the ratio 1 for 4 shares.
That means
hello.
Yes, Habakkuk.
1 per share is 0.256.
Okay, that is very nice. Which level are you? Like at university?
Level 200.
Okay. That is fine. You haven't done company accounts yet.
No, I'm not learning debit and credit accounting one.
Okay. So that it's not your fault. Don't worry. Habakkuk.
So it means that every share a holder has, they will give the holder additional 4 shares for free.
No. So if they say, Jocelyn, do you have any idea? I hope you say you have passed FR already. Or Jocelyn. Jocelyn, you say you have passed FR already. So why are you making us to suffer? 1 for 4. The bonus issue or the right issue was made in the ratio 1 for 4. You have forgot. Oh, yeah. All right. Habakkuk, if they say 1 for 4, it means that for every 4 old shares that you have in the company, we are going to give you additional 1 new share. So
I turned it.
Yes, you have turned it. So it means that give us 4 of your old shares and take 1 new share now. So if they say
okay.
one for this one, okay, bring 4 old shares and take 1 new share. That is a 1 for 4. If they say 2 for 5, it means that bring 5 old shares and take 5 new shares. So what will happen is that if they say 1 for 4, it means that you are going to bring every 4 old shares out of the 20,000 and take 1 new share. Are you getting it? So how many 4s can we see in 20,000? How many 4s can we see in 20,000?
5,000.
So it means that the 20,000 old shares will now give us 5,000 new shares. So what we normally do is that we do it like this: 1 over 4. The first figure over the second figure times the number of shares that we have. So we just say 1 over 4 times 20,000. That will give us what? 5,000, isn't it? So the right issue will be 5,000 shares. Let's assume that we are issuing this at 3 Ghana cedis. 3 Ghana cedis. So what will be the value now?
15,000.
15,000. What is happening? We are issuing at a discount of what? 2 cedis, isn't it? We are issuing at a discount of 2 cedis. Or because the value was 5 cedis, now we are issuing at what? 3 cedis. So we are issuing at a discount of what?
2 cedis.
2 cedis. So what will be the total value of the shares that we are going to have now? Total value of the shares is now what? 115,000. Are we okay there?
Yes.
What will be the total value of the shares now?
25,000.
Okay, so if you want to find the value of the value per share now, how are we going to do it?
You divide the 115,000 by the number of shares.
So we have the 115. We have the 115 divided by the number of shares, isn't it? It will be the total value divided by the number of shares. Okay. Coming, I should remove the shares over here. Okay. Okay. What is the value now?
4 cedis, 60 pesos.
So what happens? What happens to the share price? The share price has changed, isn't it?
Yes.
So in issue of right issue, what normally happens is that the original share price will now change. So we now have the actual share price after the right issue. So after the right issue, the actual share price is now what? 4.6. What happens? The share price has reduced. So the actual share price is what we call theoretical.
X.
I hope you have heard about that before.
Yeah, I think.
Yes. So we have the theoretical X right price, which is the share price after the right issue. We also have cum theoretical cum right share price, which is the share price before the right issue. So the share price before the right issue was 5 cedis, isn't it? So the share price after the right issue is now. So if you see cum means before, EX means after. So what normally happens is that when there's a right issue, the share price will automatically what? Change because of the element of the discount, isn't it? So we are going to look at how to calculate theoretical S right price. That is the share price after the right issue. And this is how we do it. The one that we have done is on total base. It's on total base. This is a total one that we do. This is a total one that we do. So what I'm trying to say is that whenever there is a right issue, the share price after the right issue will automatically not be the same as the share price before the right issue. So we have to calculate the actual share price for the shares. That is after the right issue, which we call the theoretical X right price. Are we there? Are we there? So what I have done right now over here, I've calculated the theoretical S right price on total basis. We can also do this on unit basis. If you are doing it on unit basis, what we do is that we use the proportion. We say 1 for 4, isn't it? We are saying 1 for 4, isn't it?
Yes.
So the 4 is what? The 4 is the old shares, isn't it? The 4 is the 4 is the old shares. How much are they selling the old shares before? How much were they selling the old shares? 5 cedis. So we have the 5 cedi over here. So if you multiply, what will be the value? 4 times 5 is what?
20.
20. Then we count to 1. We count to the new share. You can see that we have done the old shares, then we have done the new share, isn't it? But we are using the unit basis. So the old share. So the new share is now 1, isn't it? How much are they selling the new share?
3.
So 1 times 3 is what?
3 cedis.
Okay.
3.
So what will be the total value now? 23. What will be the total value of the shares that we are going to have? 5. So if you want to find the share price per unit is 23 over what?
Over 5.
Okay, so we do 23 over 5. What is the answer?
4.6.
So it's your choice. You can just do it on total basis or you do it on unit basis. This is how we do it. All right, so let's look at how we go about right issue. Let's look at how we go about the right issue. So what we are trying to say is that right issue is an offer to existing shareholders and enabling them to buy more shares, usually at a price lower than the current price. We have seen that, isn't it? And in proportion to their existing shareholding, in proportion to their existing shareholding, which is 1 for what? 4, 2 for 5, 3 for 5. Are you there? A right issue provides a way of raising new share capital by means of an offer to existing shareholder, inviting them to subscribe cash for new shares in proportion to their existing shareholding. What are some of the advantages of issuing shares through right issue? right issue are cheaper than IPO to the general public. You see, the IPO, if you are issuing shares to the IPO, there are some costs that you are going to incur. But if you're issuing shares to the existing shareholders, are you going to incur any cost? Are you going to incur a cost that will be too much like that? So it is always cheaper. You see, right issues are more beneficial to existing shareholders than issued to the general public. New shares are issued at a discount to the current market price to make them attractive to investors. A right issue secures the discount on the market price for existing shareholders who may either keep the shares or sell them if they wish. So right issue, what right issue normally do is that, you see, after you have subscribed to the right issue, you have the right to either sell it back or keep them. Or sometimes they can decide not to do anything. All right. Relative voting rights are not affected if shareholders take up all their rights. So even if you take the shares in the proportion, your voting right will still be the same. There will not be any dilution in ownership. No new people are coming to join the company. No, there will not be any dilution in ownership. There will not be any dilution in ownership. Let's look at some of the terms over here. Look at the offer price. The offer price is the right issue price. The price at which they are issuing the right issue, they are making the right issue, is the offer price. So in our previous example, the offer price is what? 3 cedis, isn't it? 3 cedis. So the price at which they are making the right issue is the offer price. The offer price. That is the right. That is the offer price. The market price of the shares after the right issue. That is a theoretical S-right price. That is the actual price of the shares after the right issue, as we have calculated over here. Are we okay then? Are we okay then? So the 4.6 is the theoretical X-right price. Theoretical X-right price. So after the right issue, if you want to sell shares, what will be the gain that you are going to make after the right issue? If you want to sell the shares, that you acquired to the right issue, what is the gain that you are going to make after the right issue? If you want to sell the shares that you have subscribed to as a shareholder, what will be the gain that you are going to make? What will be your gain? Habakkuk, what will be the gain? After subscribing to the right issue, you want to sell it back. You don't want to keep it. You want to maintain your old share and sell this one back. What will be the gain? What will be your gain? Habakkuk, what will be your gain? Or you didn't get a question. Habakkuk, what will be your gain? Austin, what will be your gain?
Hello.
Yeah, what will be your gain? I'm saying, should I come again?
Yes, please.
I'm saying that, you see, you have the right issue that was made. You have subscribed to the shares and you want to renounce it. You have to sell it back. If you want to sell it back, what will be the gain? You bought the shares at 3 cedis and now the share price is 4.6 and you want to sell your right issue back. You want to sell it to the general public. How much gain are you going to make from the sale?
So I'm going to make a gain of 1 cedi 60 pesos per share.
1 cedi 60 pesos per what? A share.
Per share.
Okay. So after buying the right issue, some people, they might decide to sell it back. If you decide to sell it back, you are going to buy the shares at 3 cedis. Now you are selling it at what? 4.6. So your gain, which we call value of a right, is calculated as, you can see that you have subtracted the issue price from the theoretical S-right price, isn't it? So value of a right is calculated as the theoretical S-right price minus the issue price, or the offer price. Are you okay there? So that is how we calculate the value of a right. Value of a right is just talking about the gain that you are going to make when you decide to sell the shares that you subscribe from the right issue. So the theoretical is the actual price minus the price at which you bought the shares, which we call value of a right. Value of a right. Are you okay there? Are we okay? Can we move on? Can we move on? Can we move on? Austin, can we move on? Kabako, can we move on? Jocelyn, can we move on?
Yes, please.
Jocelyn, can we move on?
Yeah.
Are you following? Or
I'm a bit confused about this.
about what?
Theoretical,
The
theoretical.
the theoretical,
Yes, the explanation for that a bit, if you can.
yeah,
give
that's
a brief.
the theoretical extra price you are talking about after the right issue, after the people who have subscribed to the right issue, what will now be the actual share price together with the old shares and the new shares, which is through the right issue? What will be the actual share price? That is the theoretical right price. And that was what we calculated with the 4.6. I hope you understood how we got the 4.6, isn't it?
Yeah.
Okay, so the 4.6 over here now becomes the new shares that we have over here, which is the 25,000 now. They are now sold at 4.6. So the 4.6 now becomes the actual share price after the right issue. So together with the right issue and then the old shares that we have, how much should we sell one share now after the right issue? How much should we sell one share now? That is the theoretical right price.
Nothing.
Are you okay then?
Yeah.
All right. So you are okay with how we calculate the theoretical right price?
Yeah.
And you're okay with the value of a right too?
Yes. Is the difference between the new price and then the old one that was issued.
Yes. So if you want to sell the shares now, you sell at 4.6, but you bought it at 3 cities. So you're making a gain of what? 1.6. That is what we call value of a right. Are you there? All right.
Yes.
Let's move on. Let's look at some of the, so you can see that the value of a right is the theoretical gain a shareholder will make by exercising their rights. That is the value of a right. Let's look at the options available to shareholders when there is a right issue. When there's a right issue, what are some of the options that are open to the shareholders? You see, when there's a right issue, it's not compulsory for anyone to take up the right. So sometimes some of the people, they decide to do nothing. They won't take up the right. So the first thing is that you can decide to do nothing. You still keep your shares, your old shares. You still keep your what? Your old shares, and you won't buy or you won't subscribe to the right issue. But what is the implication of you doing nothing? You see, let's look at this question. We have 20,000 shares first, isn't it? We have 20,000 shares first, isn't it? We have 20,000 shares first. Oh,
Yeah, 20,000 shares.
so let's assume that you are a shareholder of this company and you own 2,000 shares. First, your shares will be valued at what? 5 cedis, isn't it?
Yes.
So your total value of the shares will be what? 10,000.
Yeah.
So after the right issue, you will still be, you don't want to do anything. So you still be having your what? Your 2,000 shares. But right now, these shares will be valued at how much?
3 CDs.
No, after the right issue.
And 1 CD, 4 CD, 60%.
4 CD what? 60 pesos. What will happen to your value of the shares? Is it going to reduce or is it going to increase?
Going to reduce.
It's going to reduce by 40 pesos, isn't it? So
Yes.
if you're a shareholder, you decide to do nothing, you have to know that your share value will now reduce. Though you are going to keep the same shares, but your share price will now reduce. So always it's advisable for you to renounce or to exercise the right to take up the share so that you can keep the original value of the share. Because if you decide to do nothing, your share price will reduce. Your value of the share will reduce. Are you okay there? So that is the implication of you doing nothing. If there's a right issue, you decide to do nothing, your share price, your share value will now be what? 900. Your share has reduced, the value of the share has reduced by what? 800. Are you okay then? So the first one is to do nothing. The second one is to take up or exercise the right. Is to take up the or exercise the right. So if the right issue is there, is for you to take advantage of the right issue. So is to take up or exercise is to take advantage of the right issue, to subscribe to the shares. That is the take up or the exercise the right. The next one is to renounce the right. To renounce the right is that to buy the shares and sell them, to buy the right and sell them. So that is what we look at. So the person can buy the shares and the person will sell them. So if you look at this person, if you look at this one, okay. So if the person is having 2,000 shares, if the person is having 2,000 shares, are we okay there? The person is having 2,000 shares and the person wants to take up the rights. How many shares will the person get from the right issue? If it is 144, the person is having 2,000 shares. How many shares will the person take from the right issue? The person is having 2,000 shares and the right issue is 144. How many shares will the person take from the right issue?
1.
144. The right issue is in the proportion 144, and you are having 2,000 shares in the company. How many additional shares are you going to get from the right issue?
Is it 5,000?
144.
144, and you're having, okay, 500.
You are having
500.
You are going to have 500 shares, isn't it?
Yes.
All right. So if you buy the 500 shares, now this is the value of your old shares, isn't it? This is the value of your old shares. So if you have 500 right now, 500 shares right now, if you have 500 shares right now, these 500 shares will now be valued out what? 4.6, isn't it?
Yes.
Okay, so if you value 500 shares at 4.6, what will happen? What will be the value? 4.6. You have 2,000 what? 300. So if you have 2,300 plus 9,200, the value of your new shares will now be 5,500. This is how we calculate value of a shares after the right issue for any shareholder who take up the rights. So your old shares will now be valued at the new share price now 4.6, and the right issue that you have, which is 500, will also be valued at the new share price, which is 4.6. But let's assume that the person decides to sell. The person decides to sell all the shares. He decides to sell all the 500 shares. He decides to sell all the 500 shares. What will happen? If you decide to sell all the 500 shares, what will happen? We will just calculate the gain on the shares and add it to your value of the shares that you have. Are we there? Because you don't have the shares that you sold all the shares, so we can't value it with the share price. But the only thing, if you sell the shares, you are going to buy it at 3 cedi and sell it at 4.6. So you are going to make a gain of what? 1.6. So the value of your shares will now be 1.6 times 500, which is 800. And your total value will now be 10,000. So if the person is selling all the shares, what will happen is that the 500 rights issue will not be there, so we can't value it because the person has sold it. But the only thing that we can do is that what is the profit that you are going to get from selling the shares? So we just calculate the profit and add it to your value of the old shares that you have. Are you okay there? Are you okay there? Are you okay there?
Yes, Prof.
Okay. This is not problem. Okay. So let's assume that the person wants to sell half of the shares and keep half. So if the person wants to sell half of the shares, it means that the 2,000, the person will have additional 250 in addition to it, because the person bought 500. If he's selling half and keeping half, the total value of the shares now will be 2,250, because the half of 500 will be 250, isn't it? Are we okay? The person wants to sell half and keep half. So you have 500 shares, you are selling half and keeping half. It means that the half will be added to the old shares that you have. So we value the half using the share price now, which is 4.6. So we value the half using 4.6. That is the half that you are keeping. That is the half that you are keeping. 250 times 4.6. That will give us 1,150. 1,150. So if you are selling the half, what will happen? If you are selling the half, you only calculate the profit that you get from the selling of the half, isn't it? Are you people with me? 1.6.
I want to.
Is that?
I just wanted I just wanted to be sure about when you are selling off the shares, that's the old share.
Yeah.
That one you sell it based on the value. That's the difference.
Is the gain. What we
The
are what
gain, yes,
yeah,
gain.
what should have done is that we should have how the 500, then we add the cost. The cost of buying the shares is this one 3 cedis. So we should have the 500 times 3 cedis. That is the cost of the shares. Then if you sell it, it should have been 4.6 times 500. That would be the selling price. Then we find the profits. But instead of us to be at the shorter or to be simple in our calculation, we just find the value between the cost and the selling price. Then we just come and add only the profits. Because the shares will not be there, you are selling it. So you only have the gain. It's only the gain that will increase your share price. So we only come and add a gain. Jocelyn, are you okay?
Yes, but like you explained now, if let's say you sold part and part is left, that one you sell the one left at the current right issue price.
No, the one that you are maintaining is in the
Yes, that's
business. So you measure it at the current market price of the shares
the
because it will be in the company.
yes.
So
And then the
we
one that sold
yeah,
will
we
be
just the profit.
on
We
the
just
profit.
find a profit on it because it's not there. You have sold it to someone. So we don't have the shares with us. How can we value with the current price? But the 250, it is still, you are still maintaining the 250 in the company. So we value it at the current market price, which is the theoretical exercise price. But the one that you are selling, you have sold it to someone already. It's not with us. So we only get the gain that you are making on it and increase your value with the gain that you are making from the sale. Are you okay?
Yes.
Okay, so we can move on. All right. So that is basically about the right issue. You can renounce it. That means you sell all. You can also decide to do nothing. Some people, they can renounce. If you want to renounce, means you are selling it. But some people, they can sell half and what? Keep half. Or you can do nothing. We say that you can do nothing already. So there can be a question on the options open to them. The first one is to take up the rights or to renounce the sell all, to renounce parts and take up the remainder, which is you sell parts. Some people, they can sell 40 and keep 60. You can decide to do nothing. So let's pick some of the questions on right issue. Let's pick some of the questions on right issue. Let's pick some of the questions on right issue. So let's pick the question one. Let's pick question one. The mortgage company has issued. The mortgage company has issued 100,000 at 1 cedi per. At 1 cedi per. Do you know what we call at par? At par, share at par, share at par. If they say par value, par value. Do you understand what we call par value? Austin, do you understand if you say share issued at par? Okay, if you say share issued at par, you see the time that you are getting listed, the value attached to the shares at the time of getting listed, that is the share, or that is what we call the par value. This means that at any point in time, you can decide to sell the shares at any value. There is no specific value attached to the shares. So, but the par is just a first value attached to the shares. That is not the actual value of the shares. So the time that you want to sell the shares, you can decide to sell the shares at any value at all. That is what we call the par value. All right. So shares are okay, which are at present selling for 3 cedis per share. So you can see that the present or the current market price of the share is what? 3 cedi. 3 cedi. It has also issued 50,000 warrants, each entitling the holder to buy one equity share. The warrants are protected against dilution. The company has plans to issue right to purchase one new equity shares at a price of 2 cedis per share for every 4 shares. Required, calculate the theoretical ex-right price of mortgage equity shares. Calculate the theoretical value of a mortgage right before the shares sell as rights. So what they are saying is that the person has what 10,000 shares in issue. That is the existing shares, isn't it? That is the existing shares, which are presently selling for 3 cedis per share. It has also issued what 5,000 warrants. What do we call warrants? What do you call warrants? What do you call warrants? Warrants.
Extra cost.
Okay. Warrants is just an assurance given to the people that at any point in time, you can increase your share value by, or we can buy additional shares up to this amount. That is an assurance given to them. But a warrant doesn't exist until it has been exercised or utilized. So we are saying that we are giving you 10,000, 100,000 equity shares, but at any point in time, you can buy additional 50,000 shares. But these shares will not be there. It will not be in the company unless they bought it, unless they exercise the warrants. So warrants is a form of assurance saying that, okay, at any point in time, your shares will not reduce at this below this amount, or you can buy up additional shares up to this value. So the warrant over there is not shares in issue. It's just an assurance. It's just an option. Warrant is an option. You can decide to take it or not, but it becomes effective when you take up the warrants. Are you okay there? So the shares that they have is 100,000. The warrant is not there. They haven't bought it, so we are going to forget about the warrants. Each entitling the shareholder to buy one equity share. The warrants are protected against dilution. The company has plans to issue right to purchase one new equity share at a price of 2 cedi per share for every 4 shares. So what is the proportion? What is the proportion for the right issue? What is the proportion for the
Four.
one is for what? 4.
4 shares.
What is the price? At what price? At 2 cedi, isn't it?
2 cedis.
Okay. What is the price of the existing shares? What is the price of the existing shares?
3 cedis.
Is 3 cedis, isn't it? So they're asking us to
Yes.
calculate the theoretical extra price. We are going to use the total method and then the unit method. So if you come to the total method, how many shares do we have in issue first? It was 100,000, isn't it?
Yes.
At how much? 3
3
cedis.
cedis.
So the total will give us 300,000.
Yes.
So what will be the total number of shares that we are going to get from the right issue? 1:4. The existing shares is 100,000. So how many shares are we going to get?
25,000.
Which is 1/4 times the 100,000, 25,000 at what price?
2 cedis.
So you can see that they are issuing the shares at a discount of how much?
1 cedi.
1 cedi. Okay. So what will be the value? It will be 50,000, isn't it?
Yes.
So what will be the total value of the shares that we are going to have now?
350,000 Ghana cedis.
And the total number of shares is what?
125,000.
So what will be the theoretical extra price now? Is the total value divided by the share price. So this will give us
2.8.
2.8. Okay. That will give us 2 point. That is on total basis. But let's try the unit basis, isn't it?
Yeah.
So the unit basis, what will be the proportion for the existing shares? It's 1:4. So which of them is for the existing shares? The old shares is what?
4.
4. At how much?
3
So what will be the total price?
4.
So how many units of the new shares are we giving?
1.
At what price?
2 cedis.
2 cities. What's what to be the total value?
Mm.
See. So what will be the total value of the shares that you are going to have at units?
14 divided by 5.
14, and the shares at unit to be 5. So the theoretical SY
2.2.
price will be 14 divided by 5, right? So what is 2.8? So anyhow you do it, you can just choose any of the method that you use. Are we there? Are we there? Yes, are you okay there?
Yes.
Habakkuk, are you here?
Hey.
Okay, Habakkuk is gone. All right. So what will be the value of a right? The question is the theoretical value. So what will be the value of the rights now?
80%.
80 what?
Yes.
So value of a right is the gain that you are going to make when you sell the shares, when you sell the rights. So that will give us 2.8 minus what? 2 is the theoretical right price minus the offer price, which is a 0.8. Are we there? All right. So this is what they are asking us to do for the first part. Let's look at the second part. Let's look at the second part. The chairman of the company received a phone call from an angry shareholder who owns 1,000 shares. The shareholder agrees that he will suffer a loss in his personal wealth due to this right issue because the new shares are being offered at a price lower than the current market value. Is the angry shareholder right? Is he right? Is he right in his opinion? Is he right in his opinion?
The chairman of the company the phone.
The chairman of the company received a phone call from an angry shareholder who owns 1,000 shares. The company agrees, the shareholder agrees, agrees that he will suffer a loss in his personal wealth due to right issue because the new shares are being offered at a price lower than the current market value. Is the shareholder right in his opinion?
No.
No, I'm not sure. Like he's not right.
No, he's right because the old shares will be valued at 3 cedi, which will give the shareholder 3,000. But now the shares will be valued at what? 2.8. So if he is doing nothing, the value of the shares will now be 2,800 as compared to 3,000. So he might not be, he will be right if he decides to do nothing. But if he should exercise the right, then he might not be right. Are you getting it?
So he will be right if he decides to renounce his shares. Or
If he
No,
decides to do nothing.
that's take up.
No, his argument
that.
right now is that the value is going to reduce. So the value will only reduce if he decides to do nothing. Are you getting it? But if he decides,
So doing nothing, is it take
That
up
the
or
options is it renounce or take up?
no, do nothing is do nothing. Renounce means you take up and sell. The take up means you are going to buy the shares through the right issue. To do nothing is you just be there, you won't buy the shares. Are you getting it? All right.
yeah,
So
and renounce is you sell.
yeah, you sell. You sell all. You buy and sell all. And
Okay.
to renounce parts and maintain parts. To do nothing is you will not even buy, you will not even take up the rights at all. You will not do anything. So if he does nothing, the share which was valued at 3,000 first will now be 2,800. So the share, his value will reduce by 200. So if he decides to do nothing, he will be right. The chairman assures him that his wealth will not be reduced because of the rights issue, as long as the shareholder takes appropriate action. So you can see that the chairman was very careful with his choice of word. If you decide to take appropriate action, appropriate action over here means you should not say you are not going to do anything. You should do something. Are you getting it? prepare a statement showing the effect of the right issue on this particular shareholder's worth, assuming he sells all the right. He sells what? All the right. So it means that he will buy, he will take up the right, but he will sell all at the end. Are we there? Are we there? The second one, he exercises 1/2 of the right and sells the other. He does nothing. You can see that we have even concluded on he does nothing already. Okay. So if you want to do this one, what we normally do is that we find the value of the existing shares, which is the old one. So the value of this particular shareholder, will be, what is the value of the old shares? How many shares was he having in the company? He's having 1,000, isn't it? So old shares, value of the old shares, value of the old shares, value of the old shares. So it will be 1,000, which will be valued at what? What was the existing market price before the right issue? That was 3 cedi, right?
Yeah, 3 cedis.
So the value that he will be having before the right issue. So you can say before the right issue, value before. So we'll be having 3,000. Let's count to the value after the right issue. After the right issue. After the right issue. After the right issue, he will still be having 1,000, isn't it?
Yes.
But this 1,000 will be valued at how much?
To be valued at. Please back to the question.
No, after the right issue, before the right issue, the shares were valued at 3 cedi. So after the right issue, the 1,000 shares will be valued at how much?
I think it was
2 cedi 80%.
2 cedi 80%, 2.8. That is the actual share price now. What will be the value? 2,800, isn't it?
Yeah.
Okay, the question says that he sells all the right, isn't it? He sells all the right. Okay, so if you're having 1,000 shares and they made a right issue of 1:4, how many shares are you going to get from the right issue?
Is it 100,000 or 1,000?
He has 1,000. We are talking about the second part. The chairman of the company received a phone call from this one. So we are calculating this one from this particular shareholder, which is 1,000. Yes. So if you have 1,000, they make a right issue of 1:4. How many shares will you get?
250.
It will be 250, right?
Yes.
Okay. So these 250, you are not keeping them, isn't it?
Yes.
So how much did you buy it?
So it will be the profit.
We only use the profit. You buy it at 2 cedi, you sell it at what? 2.8. So you are making a profit of what? 0.8.
0.8.
So what will be the value? 0.8 per share. What will be the answer there?
200.
So you see that he's still keeping his what? His original value. Are you okay there?
Yes.
Okay, let's count to he sell half and maintain half. So if he sell half and maintain half, we still calculate the value of the old share. That is before. So after the right issue, you will still be having 1,000.
So
valued
I
at
think
2.8.
It will be 1,000 times 2.8 and 250 times.
No, it will not be 250. You are selling half and maintaining half. So
half.
You are,
so 5.
75.
No,
Okay.
it will be 125. Oh, you are buying 250.
25 times.
It's 125, right? So you
Yeah,
are buying
125.
250. You are buying 250. If you are selling half, that means you maintain 125. So 125 will be measured at how much?
2 cedis, 80%.
80%. So you maintain 125 in the business. That will give us how much? 1.125.
350.
Okay, 125.
350.
That will give us 350. Okay.
Yeah.
So what happens to the remaining half? He will sell it.
125 times 0.5.
0.8.
0.8. So we only recognize the gain over here. Are we there? 125 times 0.8. That will give us 100.
Yes.
So what will be his total worth?
3,250.
Okay. So it's better that you should sell half and maintain half, isn't it? Because this has
Yeah.
increased his original worth by 250. What if he does nothing? What will be the value?
He does.
Yeah, he does nothing. If he does nothing, what will be his value after the right issue?
Thousand and 2.8.
Is it?
1,002.8.
And that will give us total of what?
2,800.
Yeah, so that is the thing.
So,
He's not taking the right.
so it will be 2,800, only 2,800.
Yes, because he hasn't bought the right issue. Are you getting it?
Yeah.
So that's why the chairman is saying that he can't, if he takes an appropriate action, nothing will happen. All right, that is basically about how we calculate the theoretical extra price. And if the person decides to do nothing, sell all, and this ones, let's try another question. Then you try the rest of them on your own. Are we okay with the calculation? Are you okay there?
Yeah.
Okay, try the two for me. Try the two for me.
You should try the question too.
Yeah, if you try the two, then you come and try the six. You try six on your own. Then I'll move on to financial markets. Okay, try the two. A company with 20 million. Then you try the six.
Please, you can't see the question.
You can't see it. I thought you copy the question before you are doing the work.
Hello, boss.
Yeah.
Yeah, I had a theoretical S price to be S right price.
Okay. To be
3 cities 50 pesos.
350 pesos.
Yes,
Okay.
I did. I don't know if the 20 million times I used that one for the 3 cities 70 pesos.
Yeah, the market price of the existing shares is the one before the rights issue. So that is for the 20 million.
Yeah, and I had 74. Wait, I had 74 million Ghana cedis.
So you are using a total approach, the total base approach.
Yes, please.
Okay.
Then
Okay.
the eight, in total, I had 98 million divided by 28 million.
Okay.
Then that'll give you, yeah, sure.
Okay. Okay. All right.
Theoretical value be I had 0.5. That's 50 pesos.
Okay. Okay. So you have the theoretical to be 3.5. Okay, and this one is 0.5. Okay, nice. Yeah, just what did you get?
That's 3 point, about 100 to 3.6.
Just you say you had what?
I had 3.5, but I rounded it to 3.6.
No. Since it's 3.5, make it to be 3.5.
Okay.
Unless it's 3.57 something.
Oh,
So the 20,000 at 3.70,
Yeah.
and then 4,000 at 3.
Of course, you people are using a total base approach.
Yes, but when I tried using the other one, I'm getting 0.9 something.
No. The other one should be, you see, it will be 5 times 3.7 because the 5 is for the old shares and 3.7 is for the old shares.
Yes, and then 2 times 3.
Then you add
Okay.
maybe
I didn't multiply.
you have to multiply.
I was trying to use the other way to the individual.
It's the same thing that you see the total and the unit, the same thing we are doing, but the total we are not multiplying by the total. You can see that the total we multiply by the value before we divide, but this one we are using unit basis to do it. So it's the same thing that we are doing, but for this one we use the unit basis, not the total value. Okay, I'm happy that you are able to get that one. So you can try the remaining of the questions and send me the answer. I'm much concerned about the question 6. Question 6.
Because I think her one was 2:5 or 2:3?
It's 2:5. This one is 2:5. It's 2:5. So 5 times 3.7, 2 times 3. Then you now divide. All right. So Jocelyn, what did you get? You got the same thing.
Yes, I got the same thing.
Okay.
The first one, I used the total. I had the 3.5, and then I tried doing the individual using the unit, but I forgot to multiply.
You have to multiply. You see, mostly they will teach you the unit, but you see, if you see the question 6, it was the total basis. That is why I normally do both the total and the unit. You choose the one that you like. All right.
But to give you the same answer.
Yeah. At the end of the day, you get the same answer. Let's look at what we call financial markets. Can you see my slides?
Yeah.
Financial markets. So if you say financial market, what comes to your mind? Financial markets. Financial markets. Financial market, basically, we can say is a place where securities are traded. So stock exchange market is one of the examples of the financial market. It's one of the examples of the financial market where investors and the potential lenders meet to transact business. Is what we call the financial market. So the stock exchange market will be seen as what? The financial market. The bank will also be seen as a financial market where surplus funds are available for people to come and take and go and do their thing. That is what we call financial markets. So the stock exchange market will also be seen as a financial market where securities are traded is a financial market. So financial markets are places where surplus and deficit units need to do business. They provide a mechanism to match providers of funds, which are lenders, users of fund, borrowers. Financial instruments are traded on the financial market. Financial market provides a mechanism for individuals and organizations with surplus funds to lend funds to other individuals, organizations that are in need of funds. So bank will be seen as a what? As a financial what? Market, where people who need funds will go and get the funds. That is what we call the financial market. So we are going to look at the participants in the financial market. What are some of the people that you think will be in the financial market? What are some of the people that you think will be in the financial market? Yeah, Austin, one of those people will be what? Austin, what are some of the people that you think will be in the financial market? Participants in the financial market? Habakkuk, are you the Zoom user?
Yes, sir.
What are some of the people? So you have been here since we started the calculation, isn't it?
Oh no, sir. I went off, but I came later. I was lost, but I didn't want to extract the paper.
But
I just kept.
But you were there where you came to miss some of the calculations.
Yes.
Okay, don't worry. If you watch the video, you'll be fine. All right.
Very well.
So participants in the financial markets. Do you get a meaning of the financial markets?
Yes, yeah.
So what are some of the people that you think we can see in the financial markets?
Borrowers.
Borrowers will be there. Okay.
Investors will also be there.
Investors will also be there. Okay. You also have people that we call the financial intermediaries. The financial intermediaries are the people that serve as a middleman between people who need the funds and the people who has the fund. That is, bank will also be seen as a financial intermediary. You see, the people who, those are the institutions that bridge the gap between the borrowers and the investors or the lenders and the borrowers. That is those are the people that we call the financial intermediaries. So the bank will be seen as a financial intermediary. We also have the regulators. Regulators will be Bank of Ghana, Minister of Finance, Securities and Exchange Commission. Those are the people that are going to regulate the financial market so that people will not come there and engage in any other foolish activities. Those are the people that we call this thing. All right. Let's look at the benefit of financial intermediaries. If you say financial intermediary, we are saying that those people who bridge the gap between the borrowers and then the lenders, those who go and get the funds from the borrowers and give it to those who go and get the funds from the lenders and give it to the borrowers. Example of those people is the financial institutions. Bank can also be seen on that. You go and put your money in the bank and someone will need the money and the person will come to the bank and take the money. So instead of the person coming to you directly in the house, the person can go to the bank and get the money. So the bank is seen as a financial intermediary. One of their benefits is aggregation. What we say aggregation is that you see the bank will take small amount of money from people and put it together as a big money and lend it to someone. That is what we call aggregation. So the bank will take the small money from each individuals or each investors or each bank account holders, and the bank will put this money together and lend it to someone in a bulk. That's what we call aggregation. We also call something risk reduction. You see, if you put your money in a bank, it is safer than giving your money to someone else. So if the bank lend the money to someone and the person didn't pay, you can go to the bank and take your money. Or if you should keep your money in the house right now, you see the risk of keeping your money in the house and the risk of taking the money to the bank. Taking the money to the bank is more favorable than keeping it into your house. So the bank, if you send the money to the bank, it helps you to reduce that risk of you fearing that people will come and attack you in the house and take the money. Though people can attack the bank, but the probability of attacking the bank and doing away with your money, though they can do away with your money, but still the bank will find a way to recover the money and pay you. So there's a way of risk. The risk of you losing your investment is minimal if you put the money in the bank than keeping it in the house. All right. Maturity transformation. Maturity transformation. If you say maturity transformation is where the bank is going to keep your money over there for a long period of time and you come for it. So, so what will happen is that you as an investor, you may be thinking of keeping your money in the house for you to settle some things. So if you go and put in the bank, people need that particular money for long term. They need it a long-term loan. So the bank will help you to change the idea of you having it for cash purposes to a long-term, which you are going to get returns on it in the future. So a bank will do that. The bank will take your money, which you want for cash, and give it to people that need it for long-term purposes. That's what we call the maturity transformation. So let's look at the rules of financial markets. What are some of the benefits of financial markets? What are some of the things that the financial market do? So what do you think will be some of the rules of a financial market? What will be some of the benefit to you as an individual if there is a financial market? If there is a financial market. The first thing is that you can just go there and take money. So it's an avenue for raising funds. Financial market is an avenue for raising funds because people who has the funds will be there and people who need it will come and take it. Are we there? It's also provide a liquidity. It means that securities can easily be converted into cash. So if you have some securities or shares that you want to sell, you need cash, you can just take it to the financial market. People will come and buy and you get your cash. And you get your cash. You get your cash. So the financial market also helps people to reduce transaction costs. You see, if you should go to the financial market and deal with your securities and sell your securities, it is cheaper than you doing this business on your own. If you are doing this business on your own, you are going to incur a much cost than if you should go and transact this business on a financial market, because people are plenty over there. They are going to subsidize the transaction cost because people are plenty. The way people are plenty, the cost will be spread among them. But if you are doing it alone as an individual, the cost that 100 people will be paying on the stock exchange market or in the financial market, you'll be paying that cost as an individual, as an individual, as an individual. Okay, another one is diversification. You see, in the financial market, it gives the opportunity to people to invest in a wide range of what investment. The person will have a range of portfolios. So you have a different kind of instrument to invest in. Not that you go and invest in only equity shares. At the end of the day, something happens, your investment will be gone. So people can diversify their risk by investing in a different range of what investment or portfolio. People will be having a different kind of portfolio of investment. So you can decide to invest in bonds, equity shares, debt instruments. So you have a wide range of instruments to invest in. So if you are doing that, the risk of you losing your investment, if you should put the money into one investment, is minimized. It's minimized. So if you have time, you can read the disadvantages. Let's look at the classification of financial markets. Classification of financial markets. Classification of financial markets. Financial markets can be classified into three main groups. We have the capital and money markets. Capital and what? Money markets. If you say capital market, what comes to mind? Austin, capital markets. Austin, capital markets. Austin, what do you mean by capital markets? Joycelyn, what do you mean by capital markets?
Capital market.
Okay.
It's a financial market that deals in medium and long term securities.
Okay.
So we have
Yeah. Example is what?
Example.
We just look at source of business finance. We have the long term and short term. So what are you saying?
Yes.
Yes, Chesley. Joycelyn, capital markets.
I answer you have explained it.
And give me example.
Shares.
Okay, equity shares. So this is a market where long-term securities are being traded. Example is a debt instrument and then the
So
equity.
I think stock exchange market is a capital market.
Is that?
Stock exchange market is a capital market.
Yeah, it's a capital market because it is the long-term securities that are traded there. So any market where long-term securities are being traded is called capital market. So we have equity shares, debt instrument, bonds, and those things. Long-term securities are traded. So what about money markets? Money markets.
Money market, financial market that deals in short-term securities. So example, commercial bank 91 treasury bill.
Okay. Example is treasury bill. Okay. That is nice. So a market where short-term securities are being traded is what we call money markets. Let's come to primary and secondary markets. Primary markets. What do you mean by primary markets?
Primary market is maybe when newly issued shares securities are bought the primary market. So if we issue newly securities and they are bought, such market they are called primary market.
Okay, that is nice. So primary market is a market for first-time issue securities. It's where first-time securities are being issued. Securities that will be issued for the first time are being issued in what the market that we call the primary markets. So if you are going to issue shares for the first time, you have to issue it in the primary markets. So what then is the secondary market?
Secondary market is maybe after the first issue, if the market sells or buy that security, it's called secondary market. Okay. So maybe secondary market, they are not newly issued securities.
Okay, secondary
so
market
after
is okay. After the
new securities changes hands, maybe move from here and there, it becomes secondary market because it's not new again.
All right. So secondary market is where existing securities are being traded. So if you have the securities that have been there, if you want to go and sell it, you go to where we call the secondary market. So it's a market for existing securities or instruments. That is primary markets. Okay, we have the exchange trade or organized and over-the-counter markets. Exchange traded or organized and over-the-counter markets. What do we call organized markets? Organized markets. Organized markets. Habakkuk, do you have any idea about organized markets?
Is where a market where a comprehensive instruments are sold.
What do you mean by comprehensive instruments?
Like sophisticated instruments like Eurobonds, those securities.
Okay, you have the idea. Joycelyn. Joycelyn, are you there? Austin, are you there? Organized markets and over-the-counter markets. All right. If they say organized market, we are talking about market that is a financial market that is well structured, well organized, and it's being regulated by certain rules and regulations. So the Ghana Stock Exchange market will be seen as an organized market. They have rules, they have regulations. It is well structured. If you want to issue your securities, you know what to do, you know where to go, and those kind of things. So an organized market or exchange traded market is a market that is well structured. It's a financial market that is well structured and being regulated by certain rules and regulations. There are rules and regulations governing the operations of the markets. But if you look at over-the-counter market, it's a market that is not well regulated. We can say the Forest Bureau can be seen as over-the-counter market, because you can just go there, people can just determine the rates by themselves. They will determine the exchange rate by themselves. People that normally trade in the safer. They determine the exchange rate themselves. So and those who that have been, you can see that some people that are into this exchange, they will put tables on the road and they are exchanging money. Those markets can be called over-the-counter market. They are not regulated by anyone. And these people, they determine the exchange rate by themselves. But markets where the exchange rates, the price of the commodities or the price of the securities can be fairly and can be set by a regulation body, we say that market is an organized market. But the one that is not structured, that is not regulated, is what we call the over-the-counter market. The example would be those who put their table on the way that they are trading, they are doing forest trading. Those are what we call the over-the-counter markets. Habakkuk, are you okay there? Habakkuk, are you there?
Yes, I'm here.
Okay, so we have looked at the financial intermediaries already. Let's look at the types of financial intermediaries. We have two types of financial intermediaries, which can be the depository institutions and non-depository institutions. If they say depository institutions, is where we are going to put money, we are going to invest money, we are going to deposit money. So an example would be commercial banks, where you can go and invest or deposit your funds. So those institutions that receive deposits, will be seen as a depository institutions. Example is commercial bank, savings and loans companies, credit unions, finance houses. But the non-depository institutions include insurance companies. These people, they don't receive what? Deposit, but they receive something about lifetime savings. Lifetime savings. So the pension funds and those things, they don't receive deposits. But they just receive money on behalf of certain trustees. They receive money on behalf of certain trustees. So the money is just like a benefit or investment that you are doing, but you don't receive deposits. You don't come there and say you are coming to make deposits. No. All right. The functions of intermediaries, if you have time, look at it. Let's look at financial market instruments. Let's look at financial markets or money market instruments. What are some of the instruments that will be traded in the money market? The first one, we have the interest-bearing instruments. And we also have discount instruments. So one of the interest-bearing instruments is repurchase agreement, which we call repo. If you say repurchase agreement, is where, like, I have instruments right now, I need money. So what I'll do is that I'll come and sell the instrument to Habakkuk. And I'll say, Habakkuk, at the end of 2 years, I'm coming to buy this instrument back. So you keep it, and at the end of the 2 years, you give it to me at an interest. That is what we call repurchase agreement. It's always between two financial institutions. Bank of Ghana will need money. The Bank of Ghana will come and sell one of its or securities to commercial bank will need money. Commercial bank will sell some of its deposit to Bank of Ghana and say, I'll buy it at 2 years time. So the Bank of Ghana will keep the money and come and sell it to commercial bank at a later date, which is after 2 years at an interest. That is what we call repo, which is repurchase agreement. Are we there? Repo. Okay, let's come to what we call certificate of deposit. Certificate of deposit. So you go and deposit money somewhere, and they will give you maybe a receipt or a certificate telling you that, okay, this person has deposited this amount of money this where for this number of years. At the end of every month, the person will be getting an interest of this amount and interest of this amount. So this can be negotiable. You can negotiate with the bank or the financial institution to determine what rate that they are going to charge you or when you should come for the money. That is what we call a certificate of deposit. So you go and deposit money in a bank account, and the bank will give you a certificate of deposit as a receipt that, okay, this person has deposited this amount of money over here for this number of years, and the person will be getting an interest of this. You can also use a certificate of deposit as a collateral security to go and take loan from someone. The certificate of deposit is showing that you have money over here. You are getting interest of this amount for this number of years. So some of the banks or some of the companies use this one to take a loan. It's just something like a collateral security for you to take a loan. That is what we call certificate of what? Deposit. Certificate of deposit. Let's look at what we call the discount instrument, treasury bill. Treasury bill. Treasury bill is mostly issued by the government. The government is for short term. It's just a short term that you will buy it right now. Then they will give you the price that you are going to take at a future date. So they will discount the interest. The interest is being discounted. So you buy it at 10,000 Ghana cedis and you have 12,000 Ghana cedis at the end of the period, usually 91 days or 3 months. So these things are always in the, you can get it in the Bank of Ghana, commercial banks and other banks. So that is a treasury bill it's an instrument issued by the bank to the general public to come and buy, which normally takes about 3 months, and maybe it can be for a year. That is what we call the treasury bill. A treasury bill. Treasury bill. We also call something commercial paper. Commercial paper. Commercial paper is always given by big companies. Big companies. Okay. So big companies will issue So commercial paper is always issued by bank in respect of big companies. So you need money, you go to a bank and a bank will issue a commercial paper to whoever is going to give you the money or whoever you are going to buy from. So the bank knows that you have a good credit rating and you can pay the money. So the bank will issue the commercial paper that, okay, we are on to guarantee for this company that you can do business with this company, and we can assure you that at the end of the thing they are going to pay. So this one is always done for the big companies, because the big companies, they can actually pay. But for small companies, they will default this thing. So banks normally they do this for big companies. You need a loan, or right now KPMG, or maybe Deloitte, or maybe any of the big companies that we have in Ghana. We need a loan. This company can go to bank. The bank will issue a commercial paper, and the company will send it to wherever they need the money from, and they'll give them the money based on the recommendation or the paper issued by the bank. And this is always done for the big or large companies. It's not for small companies. It's not for small companies. It's not for small companies. All right, that is a commercial paper. Okay, so we have bankers acceptance. Bankers acceptance. So this one, I have money in the bank, but the maturity date for the money is not yet due. I have money in the bank which I'm going to cash out maybe in 2 months time. The investment will mature in two months time. But what will happen is that I want to buy something right now, but I don't have the money. But I can't go to the bank and withdraw the investment that I have, which will mature in 2 months time. So I'll go to the bank. The bank will issue what we call bankers acceptance. They'll give me a letter stating that, okay, Kofi has money with us. This money will mature in 3 months time. So what will happen is that whatever business you want to do with him, do the business up to the tone of the amount that he'll be getting at the end of the maturity date. We are going to give the money to you. So I'll come to the bank. The bank will give me the acceptance letter. I'll send it to this one. This is different from commercial paper. Commercial paper, the company will not have any balance with the bank, but the bank is just saying that, okay, because of how they do their things and they are well worthy, they are credit worthy, give the money to them. Give the money to them. Give the money to them. Or sometimes the company itself can give this paper to the bank to sign, just to sign, so that they can use it to transact business. But for the banker's acceptance, the person is having money with the bank, but the bank will say the investment is here to mature in 2 months' time. So if you want to do any business with the person now to the tone of the amount that he has in the bank, you can transact business or you can do anything to the person. That's what we call banker's acceptance. So in the exam, they can bring these ones and say you should explain them. Repurchase agreements. One financial institution will sell instrument to another and agree to buy it at a later date at an interest rate. Banker's acceptance is someone having investment in a bank which is here to mature, but the person need money. So the person will go to the bank will write a letter that this person has this and this with us. This will mature in this, so you can do any business with the person to the tone of this amount. If you come to commercial paper, it's a promising note issued by the bank to a potential lender that these people, they are credit wealthy. So you can give them the loan, you can do this. Or the company itself will write a letter, bring it to the bank, and the bank will endorse it. The bank will endorse it. So if you have some time, read through them very well. Read through them very well. So we are going to look at efficiency market hypothesis. If you are talking about efficiency market hypothesis, we are talking about a situation where if you want to invest in the financial market, you should have all the information available, all the necessary information available that will help you to determine whether to invest in this market or whether to do this. So if you say the efficiency of financial market, we are saying that the financial market having all the current information available about the securities on the market. If we talk about the information available, it's about the prices. It's about the prices. You're having all information available, all the current information available about the securities in the market. That's why we see efficiency of financial markets. The market having all the available information, all the necessary available information for the potential leaders, for the participants to make their decisions. That's what we call efficiency of financial markets. Let's look at some of the levels of market efficiency. Levels of market efficiency. We have what we call the weak form level. The weak form level. The weak form level, what we are looking at is that the financial market has only historical information, has only historical facts. The current price of the securities are not updated. The price of the security when they were issued to the market is the same price as of today. So you have only information to pass. You have access to only past information. The information about the securities over there are historical. So you don't know the current price. If you are going to buy, you don't know. So this will not even help you to make informed decisions. If you are going to make any decisions based on this particular information, that is at your own risk. So the weak form has to do with the market having only information about historical prices, having only historical facts. The price that was attached to the shares 5 years ago, the same price is there. The price are not updated. That is what we call weak form efficiency. We also have the semi-strong. The semi-strong has to do with there is an information about historical facts, and also there is information about current prices. There is an information about historical prices or past prices, and also there is an information about current prices. That is the semi-strong. We also have what we call the strong form. The strong form has to do with there is information about past prices, current prices, and also the future what prices. That is the strong form efficiency. Information about historical facts, current facts, and also future what facts. That is the weak form, semi-strong, and also strong form. Let's look at the idea of Islamic financing. Islamic financing. Islamic financing right now is a course on its own that people are doing. You see, Islamic financing, what they are trying to say is that they are saying that wealth should be generated through legitimate ways. And they don't believe in charging of interest. If they say, if you are charging interest, they assume that you are using your fellow human being to make money. That is the concept of Islamic financing. So they prohibit what we call riba. Riba is interest. They are saying that you don't have to make money by taking advantage of your fellow human being. Money should be generated in a good way. And if you are generating the money to, it should be, the public should benefit from whatever you are doing. So they care about the social welfare of the people. You shouldn't be making money at the expense of the public. You shouldn't be making money at the expense of your fellow human being. You shouldn't use your fellow human being to make money. So the idea of the Islamic financing is all about riba. They prohibit charging of interest. They say that, no, if you are charging interest, it means that you are using your fellow human being to make money. So they don't believe in charging of interest. They also doesn't believe in you doing gambling, you engaging in businesses that you don't even know about. You don't know the outcome. You don't know the nature of the business that you're going to invest in it. So they avoid investing in issues like gambling, pork, and other things. They want business that are legit. Invest in business that are legit. That is the idea of the Islamic financing. That is the idea of the Islamic financing. So charging and receiving interest is prohibited in Islamic financing because it represents the money itself being used to make money. So we don't use money to make money. They believe in using an asset to make money. You are using a long-term asset to make money. That is what they do. So the idea of Islamic financing, the Islamic financing has the following principles. Wealth must be generated from legitimate trade and asset-based investments. They believe in using assets excuse me.
Okay.
So that is the idea of the Islamic financing. I hope you have gotten the concept about Islamic financing. They don't want you to use money to get money. Even if you want to get money, that is why you say that most of the Muslims, they believe in this real estate, like they will build and rent it out. They will build and rent it out. I don't know whether some of you have seen those things from most of the Muslims. What they do is that they will just build a house and rent it out. They believe in capital investments. So if you want to make money through capital or through capital investment. So they will build a house and rent it out. They'll build a house and rent it out. But you using money to make money is very prohibited. Wealth must be generated from legitimate trade and asset-based investment. The use of money for the purpose of making money is expressly forbidden. That's what we are saying. Other ones, investment should have a social and ethical benefit to wider society beyond pure return. Risks should be shared. So if you want to go, so they believe in partnership too. They also believe in partnership. So whatever you want to do, go into it together so that whatever comes out, you share it. All harmful activities, which we call haram, should be avoided. So galamsey and those things are avoided under Islamic financing. So the prohibitions, charging and receiving interest, which is riba, is prohibited. Investments in business dealing with alcohol, gambling, drugs, pork, pornography, and those things are all considered to be harmful, which are prohibited. They are in Islamic financing, they are seen to be unlawful. Uncertainty, where transaction involving speculations or extreme risk, where you say that, okay, bring the money. If you bring the money, it will be doubled in 2 months' time. You don't even know how possible is that. No, they are saying that you should know engage in those kind of businesses. Bring money in 2 months time, the money will mature or it will multiply by 100%. No, they are saying that those things are not allowed under Islamic financing. Uncertainty about the subject matter or terms of contract. You want to do business, you don't even know what business you are going to do, and there's no contract binding the two of you. You just put money together and go and do anything. At the end of the day, something will happen. Or you want to do something that does not belong to you. You want to go and sell something that is not yours. No, that is all prohibited. Let's look at the Islamic finance instrument, the instrument used under finance, the Islamic finance, the instrument used. The first one is what you call mundaraba. Mundaraba is just a partnership contract. It's just a partnership contract. So it's a partnership contract. What we do is that you have the idea, and yeah, okay. Let's assume that Habakkuk has the idea of doing business and have the capital. So what we do is that the two of us will come together. You have the idea, I have the capital. So we come together to do the business. So since you have the idea to establish school, you don't have money. You have the idea to establish school, but you don't have money. But I have the money. So what we'll do is that we come together to carry out that idea. But what normally happens is that when there is any loss, the person with the money will take all the losses. That is about the mundaraba. Mundaraba is just a partnership contract. I have the idea, I don't have the money. But I have the idea, but you have the money. So what we'll do is that, okay, come and support me. Let's come to a partnership. If there's a profit, we are going to share. But if there is a loss, because I didn't put any money into the business, why should I incur the loss? So the loss is incurred by the person who invested the capital. So the person who brought the money is the only person that will incur the risk, any losses that will come. But any profit that will come, the two of us, we are going to share. That is the idea about the mundaraba. We also have what we call musharaka. Musharaka is a form of equity where a partnership exists and profit or loss are shared. So the musharaka is similar to mundaraba, but the only difference is that with the musharaka, what happens is that when there's a profit, we are going to share. When there is a loss, we are going to share. But for the mundaraba, if there is a loss, the person with the capital will incur it. If there's a profit, both of us will share. But for musharaka, if there's a profit or a loss arising from the business, both of us are going to share it. That is the difference between the mundaraba and musharaka. Are we okay there? Are you okay there? Joycelyn, are you okay? Can we move on? Can we move on? These are terms that pardon me, if you are Muslim, that I'm not pronouncing the thing well. Charlie, pardon me. All right. Zabakuk, you just have to pardon me. Are you getting it? All right. So the next one is what we call murabaha. Murabaha is just a form of credit sale. So in this case, what I do is that, okay, I'm doing business that I need fufu pounding machine. But I don't have the capital. So what I will do is that I'll just go to a bank and say that, okay, I need this one. So what we'll do is that buy this for me, then I will be paying you small. So what the bank will do is that the bank will just consider term value of money, and they will add more interest to it because you'll be paying, they will give you an agreed amount that you should be paying at the end of every month or at the end of every year. So it's just like the bank will buy the thing and sell it to you on credit. So you need right now you are students, you need a machine for your project work. You don't have a machine. So you come to me and say that I need machine, but I don't have money. So buy it and sell it to me. So I'll go and buy the machine and sell it to you like on credit. Then you'll be paying me small. That is about the murabaha. That is a murabaha. So for the murabaha, the laptop belongs to you, not me. The laptop belongs to you, not me, because I don't need a laptop. You needed a laptop and you don't say you don't have money, so I should buy it and sell it to you on credit. So the laptop belongs to you. The ownership and everything over the laptop belongs to you. Me, I just sold the thing to you on credit. For what we call ijara, we also call something ijara. Ijara has to do with a form of lease. Okay, you said you need a laptop. You need a laptop, but you just need a laptop for a short period of time. So what I will do is that I'll buy the laptop and lease it to you and give it to you on lease for that short period of time that you need it. So I'll buy the laptop and give it to you. If you need a laptop for 2 months, your project which is 2 months. After 2 months, you don't need it again. I'll buy the laptop and give it to you for 2 months, and you'll be paying me rentals. So that is the Ijara. You need a laptop, but you don't have money, but you just need a laptop for a short period. So I'll buy the laptop as the bank. I'll buy the laptop and lease it to you. That is the Ijara. So the ownership and everything with the laptop is mine. The risks and everything with the laptop associated with the laptop will be incurred by me, the bank. But for Murabaha, you are the ultimate owner of the asset, but just that you don't have the money, I bought it and sold it to you on credit. But for the Ijara, I'm the ultimate or the legitimate owner of the laptop. You need a laptop for a short period, you don't have money. So I bought it and lease it to you. So the laptop belongs to me. After the period, you bring back the laptop to me. That is the difference between the Murabaha and then the Ijara. Ijara is just like we have a sukuk. Sukuk is similar to a bond. It's just similar to a bond where people has a bond that someone need money, then we sell the bonds or we give the bonds back to the person, and the person will not be paying the bond holders. So the bank, you can have a bond that someone need money, then you transfer the bond back to the person. And the person will now be the people to fulfill the terms of the bond to bond holders. That is all about the instrument, the finance, the Islamic finance instruments or products. You have to take this one very seriously because it will come. They can ask you in the exam, or they can put 3 of them over there and say you should explain them. You should explain them. So that basically this is all about the financial market. The basic things about the financial market is what is financial market, the participants, the role of the financial market, financial intermediaries, those who serve as a middleman between the lenders and the borrowers. Those are the financial intermediaries. You have the banks, the financial institutions, the savings and loans institutions, and those are what we call the financial intermediaries. All right. Then we come to the types of the financial market. We have the capital, money. Last sitting, it was capital and money. They should explain them and give examples. We also have primary and secondary. We also have organized and over-the-counter markets. And you can also have, sometimes they can also say forex markets. Forex markets. Forex markets. If they ask you forex market, what are you going to say? If they ask you forex markets.
I think it's a market where currencies are traded.
Okay, so that is forex market, where currencies are being traded, where currencies are being exchanged. So they say interbank markets. Interbank markets. Interbank markets. What are you going to say? Interbank markets. If they say interbank market, basically they are talking about a market where only banks meet to do business. So you can exchange securities. It's only for banks. It's only for banks. That market is only for banks where they meet and do their transactions. So basically, that is all about the financial markets. Do you have any question as to sources of business finance, financial markets, and any other thing that we think is appropriate? Do you have any question? Austin, do you have any question?
No.
Okay. Habakkuk, do you have any question?
Okay.
No, sir.
Please, will you be giving us maybe assignment on these topics, maybe?
Yeah. I'll just look. It's because they are theory. That's why I don't use to add theory this one. But I'll look for some of the questions and I'll send it to you as a try questions.
Okay, sure.
All right. So if there is no question, we call it a day. Serious. I have to do something and do MA at. I have MA at 5 p.m. So I have to get some things and eat and continue again. So, Charlie, we call it a day.
All right. See you in the evening.
All right.
Okay. Bye.